Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 25 minutes here on Options Guide TV. Today's date is Monday, June 17th. Markets are open and rocking and rolling. We're going to look at our Russell 2000 trade that we put on Friday. We got a movement to the downside, which we're kind of hoping for, but we need a bigger movement in order to make this a profitable trade. But we did get the breakdown a little bit, and we're going to continue with this bearish stance in the Russell 2000. The underlying that we're using to trade in is the IWM, which is the most liquid ETF that actually trades based on that index's value. And we'll look at those trades today. But I also want to mention that on Wednesday, the markets are closed. We will have an Options Guide TV. It will be educational based, but that's why if you look at a lot of the expiration dates, you might be scratching your head as to why in the SPX and the IWM there is no June 19th date. And that's because that's Wednesday and that's a federal holiday. It's called Juneteenth. And the markets will be closed on that day. So I don't think they were closed last year. I think this is the first time doing it. So I thought it was worth mentioning. Maybe they were closed last year. I don't want to put my foot in my mouth. I do know that it's now a federal holiday. And so because of that, it's the only Wednesday that the market is actually closed. The only other holidays are usually on Monday or they're on a Friday. And then you got that weird little thing that happens over Thanksgiving. So with that said, let's jump into the IWM. So let's go to the TradeHawk software. And we're going to look at the buying of a put and a call at a limit price of $5.48. That was our long-term trade that we did in the IWM. We debated if we wanted to go out into the July period, which would have been it would have contained the 4th of July. So the July expiration, July 5th expiration, which is the Friday of the 4th of July, was 18 days away, and July 12th was 25 days away. We decided to go short term, and we're just looking for some volatility, and with the expectation that really think the market might bounce to the downside more than to the upside on that trade. So this is our first trade. So let's go to that expiration date, which is 6/28. And we have 11 days remaining on the trade. Here's what we did. We bought the 199 strike call, which is the most at the money option contract at the time. The underlying market was 198 and some change. So we were just a little bit in the money on the put side of things. And then we bought the 199 call option. Call option is losing money. The put option is gaining money. We paid $5.82 for it. So $5.82. So we are down a little bit on the trade. And that usually will happen to start with on a long straddle because you need to build the momentum in one direction. So if you don't get the big move right away, you'll get some time decay issues. You need to get some intrinsic value on one side of your of the play. Either you need to build some intrinsic value on the put side or on the call side. It's not a bad move today, down about 0.5%. It's trading at 197.81 right now. So in this instance, we would look to sell the long put if we could for somewhere around $6 or $7, depending on where we feel we are in the marketplace. So I always like to leg out of long straddles. And if we even got a smaller movement to the downside, might even actually sell the call option and take some risk off that way if we still got some premium. So for example, an easy way to look at this and to get a feel for where your options may be, if the market, this is the 199 strike call. We're at let's call it 198. So we're 1 point in the money on the put side of things. On the call side of things, we're now 1 point out of the money. If the market did go down, let's say it went down to 196 or 195, we're going to be looking fairly good on our straddle, just in general, well, we're going to be looking fairly good on our straddle. But if that happened, it's interesting to know where would our call option be. So if we went down to 195, that would be 3 points below. All we got to do is move up the chain 3 points. So we're going from 199, 3 points would be 202. Our call option at this point in time, now using the current market conditions, should be still trading for somewhere around $1, right? Because right now we are 1 point out of the money. If it went down 3, we would be 4 points out of the money. And that total amount right there would be trading for what the 202 is trading for right now. So you're just looking at the change, trying to develop a realistic expectation of what you might be able to get for the call. So if it happens somewhere around $1, we might be able to sell that for, and then we could also just ride on the put side of things. Now, if we get a big move, let's say we get a 2% move, a solid move to the downside in IWM, then we might not leg out of the call. It's all about how violent the reaction is on the put side. Now, we're hoping that we broke through a support line a little bit. We're kind of hoping that it maintains that and develops a new channel below where it's currently trading at in IWM by looking at the chart. And as a matter of fact, I'll just pull that up instead of talking about it. So here's where the support line was drawn that we had based off of the previous channel. That was a real strong support area. There's a lot of noise that has happened right around here. You see how many times it's came up and bumped up against that line. And if you go back further in time, you'll see that market has came up and bounced off of that when it had a real nice long channel. So, excuse me. And so the underlying has now broke down below that. It hasn't really established itself, but this is the 200-day moving average, and there's obviously some support down here. You can see that it's very, very possible over a week's period for this market to move from, as well, in this instance, it went from 207 all the way down to 199. And if it continues, you could see this is the next level of support would kind of be right in here. But obviously, you're kind of targeting this area right down here, right about where the 200-day moving average is at. It would make a lot of sense. So that's our goal. We're going to keep riding the trade. We have a plan. If the market kind of goes down, we might sell the call option, which would alleviate a little bit of our risk and hope that we still get the put option to roll for us. And then we got about a week in this trade, and then we're going to get out of it. We don't want to try to ride it all the way to the end. If the market's hanging right here, right at 199 in a few more days, we might just take the position off just because we're not getting the violent move in either direction in that instance. Okay, so then got a shorter term trade that's going to expire on June 18th. And I actually have that in the what if calculator. So let's see, I'm froze a little bit here. Let's go over to the what if calculator. And in this instance, if I'm zoom in a little bit here, we did the trade. The market was right here, right around 199. And we did it for a 5-cent net credit to the account. So that meant the market went this way. We could, and the options all expired worthless. We could make that 5 cents. On the way down, we just didn't want the market to come down and hang right at 197. And that's what it's doing right now. So if I pull up this trade and I actually send this to the what if calculator, it's not updating. There it goes. Okay, so we're seeing a 36-cent net credit to the account. Now, that's the real trade. You'd have to flip the script if you were getting out of it. So we did it. We put the trade on for a net credit to the account of 5 cents. We have 2 points of risk. Basically, the width of the spread is the maximum risk that we have. And we're now trading at 34 cents. We'll call it 35 cents, make it simple. That means right now, there we go, 35. And that means that would cost us 35 cents to take the trade off. So right now we're down 30 cents on the trade, but we got the market moving in the right direction. We just needed to move a little quicker in this direction. And if at the end of the day, we're trading right around 197, we're probably just going to take the trade off. You got one full day of trading, which would be June 18th. We really need the market to make a stronger move to the downside. We want to get down to about 196. That would be a good trade in this position. We have 2 points of risk. That's the maximum. It actually 2 points minus the 95 cents that we brought in. So it would be $1.95 if you rode it all the way to expiration and it stopped right at 197. And that's shown in the what if calculator here. So it'd have to be right there for you to lose the maximum on your trade, right on that point. So if we get down to 196, we're doing pretty good. 195, we're doing great. And we got a day and a half for that market to try to move in that direction. So we'll see. We'll let that trade ride for the rest of the day, and we'll come back. Well, we maybe I'll do a quick review of it on Tuesday, since we'll probably be taping Options Guide TV because of the Wednesday holiday. So that makes a lot of sense. So maybe I'll do a quick review of this trade, and then also talk about a little bit. Usually talk about option pricing when we're getting into the educational stuff. All right, so I want to keep this theme. So I'm going to stick to my guns on IWM. Want to be bearish on the trade. That was a speculative trade. That's actually called inside the playbook. And let's zoom out, and I'll bring this. Let's zoom out a little bit here, and I will bring up the options playbook. So let's do that. And let's zoom in on the playbook a little bit. There we go. And then you're seeing this is what the back spread with puts looks like. Now, inside the playbook, we've added a couple of things. One of the things that we've added is some graphics. So you're kind of seeing how this reacts as you go through time. It starts from a 24-day period out, and it works its way all the way to the expiration date. And then at expiration, you got a break even here and a break even here. This is actually a break even on the downside. So if you have it on the upside, you really need to get to where that middle strike is that you own, 95, minus 2 points, which is the width of the spread, which would be 190. Oh, I'm sorry. This was 197. It'd be 195. From that on up, if the market keeps going down, that's very good for this trade. And that's what we're kind of looking for, was a perhaps 2% or more move to the downside over from Friday at noon until the close on Tuesday. And so we got a little bit of the move, but we need a little bit more violent move to the downside. So this time around, I'm just going to look at a long put spread, and we're going to set up that long put spread more at the money. We're going to use the same type of rules that we've used for a long call spread, where we're going to sell the most at the money option contract, and then we're going to buy a little bit in the money. So we're going to be a little bit out of the money, a little bit in the money. And if the market does go down or goes the wrong direction for us, we would roll that into a butterfly trade. So this is going to be an independent trade. Relative to the positions that we have on right now, we're going to treat this as a new position in IWM, and we're just going to put on a long put spread. So we're going to go out a little bit further in time. Well, maybe we'll keep with that same expiration. So let's zoom back out, and we'll run back over to TradeHawk Software. IWM, I think this one, let's go beyond the July expiration. Let's go all the way out to, and give this a little bit more time, because I don't plan on being in it the whole time. We'll do the July 5th expiration right after the 4th of July. And we're looking at, right now, the market's at 197.81. We'll do I don't like to do the half point strikes, but you usually get better open interest if you go off of those half point strikes. So I think we're going to do the 197. That's where we'd like the market to go to and beyond. So let's buy this one. We're going to sell this one. So we're going to hit that bid, clear this out. Let's hit that bid. And then we will buy the 200 here. All right, 145. So you have a 3-point wide trade, and you're paying $1.45 for it. If we look at the extrinsic value, you are buying $1.95 of time premium, otherwise known as extrinsic value, and you are selling $2.70 worth of time premium, which is a really strong market. And you're able to get almost a 50-50 trade. Now, we're not quite at the money, but we're 197, so we got 79 cents that it needs to go down to get to our short strike on our trade. But if the market basically drifts lower or even just stays where it's at, we're still going to be profitable on this trade. So 200 minus 145 would be 198.55. Decent break even. Market stays where it's at or drifts lower. This is a good trade. And if it obviously goes lower, we're doing well. So I don't mind this setup on the trade. If the market did come back and it blew through the 200 on the upside, we would look to roll this into a butterfly. And we've done that a few times on the long call side of things. That's a quick adjustment saying, I don't want the cheese anymore. Just let me out of the trap. Bringing in some income, not adding any additional margin to the trade. And that's the way that we're going to approach this trade. So I'm looking at this independent, even though we got the long straddle on, it's getting a little bit messy if we were in our actual portfolio. But I do want to look at a trade where I am long a put spread, and I want to be able to have an adjustment in my pocket if I need to. We got plenty of time. We're going all the way out to, we got 18 days going all the way out to July 5th on this trade. And this will be the official paper trade for this week. We'll come back on Tuesday. I will look at what happens with the IWM back spread, and we'll talk about that. And we'll keep this along with our long straddle, and we'll watch these positions over the next 10 days or so and see if we want to make any adjustments in either of those positions. Now, if you have any questions or any comments, you can put them in the chat box if you're on YouTube. If you're in the Tradier Hub, you have to log in order to be able to ask questions. Just want to let you know that. But you can submit any questions that you may have inside the Tradier Hub. And I'll give you a second if you want to add a question or two. Don't forget, Wednesday, the markets are closed. That's going to throw a real twist in things for this week's trading. And you can also follow me on x.com. My handle is very simple. It's at Brian Overby. And we do stream live in x.com. And if you are watching through X, thank you for joining us. And we will probably see you. I don't see any comments at this point in time. So we'll see you next Friday live for the next version of Options Guide TV. But you might want to tune in Wednesday. We will have a recorded version if you're just hanging out and not watching the markets. We'll give you something to watch on the Tradier Hub. Thanks for coming by. And we'll see you live this Friday at 11 a.m.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.